Hi, I'm Bhaavya Rastogi, and welcome to my GT Mentorship Final Showcase presentation on credit scores, how a higher score can save you money. Credit scores are extremely important to the financial security of an individual, and it is because credit scores can impact your ability to borrow money, make big ticket expenses, and even find a job that I decided to research this topic. So in this presentation, I'll go over the components that make up credit scores and the research I did to quantify how a higher score can save you money. So credit scores can be described as a grade that indicate your credit worthiness. And there are many different types of credit scoring models. But for the purposes of my presentation, I decided to use FICO scores as they're the most prevalent and widespread credit scoring model. FICO scores, as we can see in this image, run on a scale from 300 to 850. As Vantage Score, another scoring model company explains, the three-digit credit score value is a numerical representation of the likelihood that a consumer within a specific population will become 90 days or more past due on a debt obligation in a 2-year timeframe. This is a level of risk referred to as propensity to default. So essentially what this quote is telling us is that credit scores don't assess an individual's chance of defaulting, rather they measure the probability that one will default in relation to other consumers. FICO scores explain a consumer's risk in relation to the entire US population and are calculated using the following categories and percentages. So as we can see, payment history makes up 35% of your credit scores. Essentially, lenders want to know if you will be making your payments on time and how you've handled other loans in the past. Your history includes derogatory marks such as bankruptcies, foreclosures, or an account in collections. These marks, or even just a single payment, can sink your score significantly, as this picture depicts. The second category that is factored into your credit score is credit utilization, which makes up 30% of your score. This category refers to your credit cards and your total capacity to borrow. It can be calculated by taking your total credit card balances and dividing them by your total credit card balance limits, as this picture depicts. Keeping your balances under 30% of your utilization rate is important for good credit because it indicates that while you have the capacity to charge many expenses to your card, you actively choose not to. The third category is credit age, and this is referring to the average amount of time that all of your accounts have been open. So if somebody's average length of credit is 6 months and they decide to open like 8 new credit cards, their average length of credit would decrease. The next category is types of credit. So essentially, lending institutions like to see that you have a good amount of accounts open and also that a lot of variety in types of accounts open because it shows that other lending institutions have deemed you worthy of credit. Other types of credit include revolving, installment, and even student loans. The last category that's factored into your credit score is number of inquiries. So a hard inquiry occurs when a creditor checks your credit report to make a lending decision, and it results in a score deduction most of the time. Applying for different credit cards or loans results in many hard inquiries, which makes it look like you might not be getting approved for credit from these other lenders and makes you seem like other people aren't deeming you worthy of credit. That's why it's best to minimize how often you apply for more credit. So now that we've covered the basics of credit scores, let's go into my research. So firstly, I'll be going over some research that has been done on the past on this topic, the limitations of that research, what I decided to do my project on, the conditions I used, and my findings, conclusions, and ending with the limitations of my own research. So, does knowing your FICO score change financial behavior? Evidence from a field experiment with student loan borrowers. So this report, by the individuals who are named in the title, tested an alternative approach to traditional classroom-based financial literacy. They provided a large-scale sample of Sallie Mae's clients, which is a national financial institution that specializes in student loans, access to their FICO scores. And as a result of their experiment, the authors were able to conclude that simply knowing what your credit score is can positively impact your financial behavior. This is because most people tend to believe their credit score is higher than it actually is, causing them to be less concerned about it. But one limitation of this research is the fact that it doesn't actually consider other facets of financial literacy, like being able to save and invest money effectively. This research is only able to conclude that credit awareness for these members led to an overall decrease in derogatory marks for the population. Not that student loanees were overall able to, for example, save money in interest rates due to higher credit scores. And that's why I decided to do my research on how having a higher credit score can actually save you money. So my research attempts to prove that increasing your credit score by 50 points can directly translate into long-term savings, which is referring to the savings in the difference in interest that would accrue against your loan if you have, for example, a higher interest rate. This I did essentially by taking each credit score in 50-point increments from 550 to 800. And I used online simulators to calculate either the interest rate of the loan or how much interest would accrue against the loan over the lifespan of the loan. And then I compared these values. I used these conditions to ensure that the averages of multiple sources were correct and that I wasn't taking any other information that would impact the interest rates or the values that I got. So essentially to keep everything the same and to ensure that the data was accurate, these were the conditions I used to find my numbers. And this slide actually explains where I got my numbers from. So for auto loans, I took data from 3 different sources. For mortgages, I took my source from 2 different websites. And then for personal loans, I only used one source because the thing with personal loans is that the interest rate tends to vary greatly depending on the terms of your loan and, of course, your lending institution. So as we can see here, this is the data that I collected from each of the different resources. And then taking this data, I took the average annual percentage rate for auto loans and mortgages, and then I graphed them alongside the percentages for personal loans. So as we can see here, the biggest disparity in interest rates due to credit scores occurs with personal loans, which is the green graph pictured here. But we can also conclude that mortgage interest rates only differ by around 1%. But your credit score really makes a huge difference in your mortgage as well, because as we can see, we don't even have data for the interest rates of credit scores that come before 650. So essentially what we can conclude is that you can't really apply for a mortgage loan at major loaning institutions if your credit score is not higher than a 650. For personal loans, we can see that after a FICO score of 570, the interest rate stabilizes to provide no additional benefit to having a higher credit score. But still, the annual percentage rates for both auto loans and mortgages continue to drop through the entire as you move up with your credit score. And it's kind of hard to understand sort of the impact that having a higher or lower interest rate can have on your savings. So I decided to make this slide, which easily depicts that if your credit score was 50 points higher, you would save. So for example, if your credit score was a 700 instead of a 650, you would save over $1,300 on your car loan and over $7,000 on your mortgage. I think this slide pretty accurately depicts the sort of actual savings you would have from having a higher credit score. So I would highly suggest if your credit score is around the realm of 650 to get it to 700, because after that, the benefits definitely are quite large in terms of saving money, as we can see in this slide. So, to summarize, increasing your FICO score by 50 points can result in overall lower costs for long-term loans like auto loans. And we can see that there's a strong negative correlation between credit scores and each of the 3 types of loans we included in our simulation. But as we saw with personal loans, the relationship with having a higher credit score and lower interest rates for your loans isn't boundless. But of course, there are limitations to the data that I collected. So the most sort of obvious and problematic one is that the correlation we depicted in the past graphs is not going to be as strongly negative when other financial factors are considered. So for example, numerical values such as your debt to income ratio are considered by lending institutions when you apply for a mortgage. So essentially, if you have a low credit score, it may not be the end all for you if you don't think you can afford a loan, because most lending institutions will take other factors into account, like your debt to income ratio. And so when we were conducting this research, I operated under the assumption that the creditors would only look at your credit score and the other values we had outlined in our conditions to determine your loan's interest rate. We also only operated under the current social, political, and economic atmosphere to come up with the numbers of our interest rates or the amount of money you would save. But those sort of values may not hold true at a different point in history, or we can't really say that the interest rates will hold true from month to month or day to day. But we can conclude that raising your FICO score by 50 points will definitely lead to a lower interest rate for your home, auto, and personal loans, because there's still a very strongly negative correlation. So that's the end of my presentation. I'd like to give a special thanks to Ms. Zulika Diaz and Ms. Renee Canavo for providing so many resources for me during my time spent at the Houston Federal Credit Union. And I'd like to thank all of you listening to my presentation now for taking the time out of your day to do so. Thank you.